All right. Chuck, are you with us? Yeah, I can hear you great, Chuck. I can hear you great. So thanks for joining us. Thanks for taking the time, Chuck. We have a pretty big attendance today. So nonetheless, why don't we go ahead and get started? I'll make you the presenter, and then we can share our screen and start the webinar.
Okay, sounds good. Thank you, everybody. This is Chuck Hughes. Thank you, Tom, for setting up this educational webinar today. I actually enjoy doing these educational webinars, and over the years, I've learned a lot from questions that people asked during the webinar, and that led to research and it led to some of the techniques that we use in our actual trading. So I actually learn from these webinars also. So it's great to be here today, and we're going to talk about the using this year that are working pretty well this year. In general, the market was not but now it's starting to break out. So our strategies are doing even better in this market that's starting to trend. We went so long without a trending market that it's good to see a trending market. So we're going to look at the strategies that we're actually trading this year, and we'll look at actual trade examples to demonstrate the strategies. We actually have these trades on right now. We'll look at the weekly paycheck strategy, the stock spread strategy. We'll look at the directional option trade strategy, the option debit spread strategy, and the market neutral spread strategy. Let's look. The first strategy we'll look at is what we call the weekly paycheck strategy, and weekly covered calls every week, and at the end of the week we close out the expiring weekly option, and then we sell to open the new weekly option, and we have a new trade every week with weekly covered calls, and that actually generates cash income every week as we sell those options. So the covered call strategy is implemented by buying 100 shares of a stock or an ETF and selling a weekly call option. You can get started with about $3,500 to purchase 100 shares of an ETF or a stock and start selling weekly call options. An option premium, cash is immediately credited to your brokerage account, and each week when we sell options, we collect that premium, which is actually cash going into our brokerage account. So, for example, if you sell an option and it has a 4-point premium, then $400 in cash is credited to your brokerage account, and that cash reduces the cost basis of the stock and reduces the overall risk of the trade. And what we do is when we receive that cash every week, that starts to build up, and then we purchase more covered calls, and we start to compound our returns pretty quickly. So the options can lead to 100% cash on cash return regardless of the price movement of the underlying stock, and I'll show you an actual example of that right now in a few minutes here. If you invest $3,500 in a weekly covered call, you could receive $3,500 in cash income over the course of the year. And these weekly covered calls have been profitable during various types of market conditions, non-trending markets, trending markets, volatile markets, non-volatile markets. So they've been pretty consistent performers. And this strategy incurs less risk than owning a stock or an ETF. So weekly options start trading on Thursday, and they expire the following Friday, and they have a trading life of 6 days. And as I mentioned, we have 52 opportunities each year to sell option premium. So this allows us to roll over our profits and compound our returns. So let's look at an actual trade example that we have on now. And this is the first part of a covered call, is buying 100 shares of a stock or an ETF. So our brokerage statement shows that we bought 100 shares of ERX. That's the leveraged energy ETF, and we paid $31.47. So bought 100 shares of ERX at $31.47. And the covered calls is to sell to open a option. So our brokerage statement shows this was the same day that we purchased the 100 shares. At the same time, we sold to open the ERX September 2nd 31 strike call at 110. So the September, that was a weekly option. So that September 2nd call expired September 9th, and then we sold another option on September 9th. And this call was sold for 1.10. So after commissions, $101 was credited to my brokerage account. So we bought the 100 shares of the energy ETF, and then we sold to open the September 2nd weekly call. And what we'd like to do each week is roll over the expiring call option and then sell to open the new call option. So when we do that, we can keep the stock or the ETF in our account. So the way we roll over is to buy to close the expiring weekly option and then sell to open the new at the money weekly option. So here's of this ERX covered call that we kept rolling over. So second, we sold to open the September 9th weekly call at $156 after commissions was credited to our account. So the September 2nd call was expiring. We closed that out, sold to open the September 9th. And then we did the following week, we sold to open the September 16th. Then we just kept doing this, sold the September 23rd weekly option, September 30th, October 7th, October. These are just our actual rollover trades where we sold to open the new option. So over this 10-week period, we collected $1,264 in cash payouts after commission. So this averages out to $126 per week in cash payouts. And we invested about 31, we bought the 100 shares and we invested $3,156 to get this covered call trade started. So if we were to average $126 each week coming in times 52 weeks over the course of a year, we can collect $6,500 in cash. And remember, the initial cost was $3,156. So that's about a 207% cash payout based on our initial cost. So this $6,500 in potential cash payout would help reduce any losses if the ERX ETF dropped in price, and we could wind up profiting whether the ETF was up, down, or flat over the course of the year, and we could profit even when we entered the trade. So, and as I mentioned earlier, we like to compound our returns by using our cash payouts to purchase additional shares in ETF and then sell additional call options. So if you receive a 207% cash-on-cash return, a lot can go wrong and you're still going to profit from the trade. The underlying stock or ETF could decline 20, even 50%, and you could still profit. And if you had bad timing when you entered that trade, you could still profit. Now, there's always a risk of getting called with a covered call, but as I mentioned, each week we roll over that covered call. We buy to close the expiring call, sell to open the new call. So that way we get to keep the stock in our account. So there could be volatile price swings in the underlying stock or ETF, and you could still profit. So this gives the weekly covered call strategy a big advantage over directional trades that require the stock or the ETF to move in the right direction in order to profit. Okay, criteria for selecting ETFs for the weekly covered call trade weekly stock covered calls, and we trade weekly ETF covered calls. And when we're looking at ETFs to initiate a covered call, we look at three things. We want to make sure that the ETF trades weekly options. That allows us to collect 52 premiums a year versus an ETF that only traded monthly options when you would collect 12 premiums. And we'd like to see an option premium that gives you at least a 1 to 2% weekly cash payout from selling at the money calls. So if the stock is trading at $100, we like to see at least a 1 or 2 point cash payout every week from selling the at the money calls. And the last thing we look at is we want to make sure that the price of the ETF is trending up, and we just simply look at the 1 month price and make sure that's above the 10-month simple moving average. So these covered calls are neutral to slightly bullish strategy. We just don't want to do them on a stock that's in a price downtrend because there's too many good stocks or ETFs that are in a price uptrend. So we just look and make sure that the 1 month price is above the 10-month simple moving average, just to make sure that the stock or ETF is in a price uptrend. So let's now look at directional option trades. That's another strategy that we use. And as I mentioned before, the market's starting to trend now, whereas they weren't for the last several years. So these directional option trades are starting to work out pretty good. And we use what's called the prime trade select system to select optional directional trades. And once we enter an option trade, if we buy a call option, we have 3 simple rules to manage trades. Once we enter a trade, we'll exit losing trades quickly before they turn into a loss. So if the option trade, if we have a bad trade, it didn't go the way we thought, we usually exit when we have about a 20% loss or so in the premium. We'll just simply exit the trade and then look at the next opportunity. And the other important management rule is you don't want to exit winning trades with a small gain. That's very important, because if you keep taking small profits on your trades and you don't let them develop into big winners, that can really hurt the performance of your portfolio. So we exit the losing trades quickly, and we hold on to the winning trades and let them develop. And that's worked very well over the years in directional call option trades. And the third trade management rule is we use options to protect profits with a winning trade by creating a spread trade, and I'll show you how we do that in a minute. So if we have a profit in a call option, we always want to protect that profit in case the underlying stock or ETF declines in price. So we stick to these 3 trade management rules once we enter a call option trade. And I just wanted to mention we have right now all bullish positions in our option portfolio and also in our option spread portfolios. However, during the last 2 bear markets in 2001 and 2008, we were heavily short the market. We use a trend following system, and to enter trades, and that trend following system got us short during those bear markets. So these strategies I'm showing you today also work to establish bearish positions and profit during bear markets. So when you buy a call option, the underlying stock must increase in price above the strike price of the option at expiration, or you'll incur 100% loss on the option premium. So whenever you buy an option, you're always faced with the possibility of 100% loss when you're when you purchase a call option. So the underlying stock must close above the strike price, or you'll lose 100% of the premium. And this is a snapshot of the VIX index, the fear indicator, over the last several years, and every one of these spikes here represents a market sell-off. So if you're buying call options, you can see there's quite a few sell-offs over the last several years. Every one of these spikes is a sell-off. So you got to be careful when you enter these directional trades, and we develop Prime Trade Select that helps us get a good entry point when we're in this kind of a market where there's a lot of sell-offs. And the goal of Prime Trade Select is to avoid getting stopped out of the trade. So we use Prime Trade Select to select the option directional trades, and then the goal is to avoid large losses. And as far as option trade selection, we like to keep it simple. The option trading doesn't have to be complicated. Our mantra is to keep it simple. Options, of course, are derivatives, and they derive their value from the price of the underlying stock. So call options profit as the underlying stock moves up in price. Put options profit as the underlying stock moves down in price. And it's the price movement of the underlying stock that really determines the option's value and the resulting profit or loss for the option trade. So if we can select a stock moving up in price, purchasing a call option on that stock can produce big profits, and it allows us to harness the leverage provided from option investing. And we use a simple trend following system to select our trades. We've been using this for many decades, and it's a very simple trend following system. And if the stock is moving up in price, then the stock is on a buy signal. If the stock is moving down in price, then the stock is on a sell signal. And of course, if stock is on a buy signal with our trend following system, we want to buy call options. And if the stock is on a sell signal, according to our trend following system, we want to buy put options. And it's just that simple. Everything else, we don't pay attention to anything else. And it only takes a few minutes on the internet to pull up a daily price chart to determine if a stock is on a buy or a sell signal. And by using a trend following system, that allows us to follow the current price trend of a stock instead of trying to predict the future price movement. So a trend following system eliminates emotional decision making and gives us the discipline we need to be successful traders. And as I mentioned, our trend following system was bearish during the last two bear markets when we had short positions. So let's look at our Prime Trade Select system. We have 3 steps. First step was we determine the price trend of stock using the 50 and 100-day exponential moving average system. And step 2 is we select a low-risk entry point using the Keltner Channels. Step 3 is we use what we call the 1% rule to select an option strike price with a high probability of determine the price trend of a stock with the 50 and 100-day EMA system. And the exponential moving average is above the 100-day exponential moving average, then that stock is on a buy signal. And if the 50-day EMA is below the 100-day EMA, then the stock is on a sell signal. So let's look at an example. This is for Starbucks. And this chart shows the daily price movement of Starbucks with these vertical black and red lines right here. And this blue line is the 50-day exponential moving average. The red line is the 100-day exponential moving average. So we can see right here, the blue line crossed above the red line. So at that point, Starbucks stock was on a buy signal. And as long as the 50-day exponential moving average is above the 100-day, then the stock remains on a buy signal. Here's an example of the sell signal. We can see right here the 50-day EMA crossed below the 100-day EMA, and at that point the FXI was on a sell signal. And step 2 is we want to select a low-risk entry point using the Keltner channels. And the Keltner channels are similar to the Bollinger Bands. They're an over indicator. This price chart shows the daily price movement of Home Depot stock with these red and black vertical lines here. And then over the Keltner channels, we have the upper Keltner channel, which is this upper blue line right here. The middle channel is this dotted line in the middle, and then we have the lower Keltner channel here. So when near the upper channel, it's overbought and normally retraces lower. So the stock got up near the upper channel, overbought, retraced, overbought, retraced, overbought, retraced. So the goal is we don't want to buy a call option or buy the stock when it's trading near that upper channel because it's getting overbought and it's normally will retrace from that point. So what we do is we wait until the stock trades down near the middle channel, this dotted line, or the lower channel before we buy the stock or buy a call option. So we only look at stocks that are in a price uptrend when the 50-day EMA is above the 100-day EMA, and then we wait for a retracement to the middle or lower channel before we enter our trade. And the stock is up near the upper channel because it's overbought. Get some examples using the Keltner channels, and what I'm going to display here are brokerage account transaction reports that show that we bought a call option, and then I'll depict on the chart where the day that we bought the call option, and you can see that when I show these charts that the Keltner channels helped us get a low risk entry because the market didn't retrace much from our entry. So the first example is for the XLU, the utilities spider, and right in here we can see XLU was in a price uptrend. It got overbought, retraced. So right in here we bought the 40 strike call at 6:30. So we waited for the retracement right here, and then you can see that it went on to new highs, and by buying at this retracement, we got a low risk entry point for our option trade. Here's another one. This is the Real Estate Investment Trust ETF, VNQ, in a price uptrend, waited till it retraced, and then we bought the 70 strike call at 1334. Here's another example. This is the Dow Jones iShares dividend ETF, again in a strong price uptrend. And the question is, when a stock or ETF is in a price uptrend like this, where do you jump in? And we like to see a retracement first, so we waited till it retraced here, and then we bought the 70 strike call at 1170. That got us a good entry point. Here's one more example. This is for Amazon. Price uptrend for Amazon. We waited till it retraced to that middle channel and then bought the 330 strike call at 113. So these using the Keltner channels resulted in low risk entries for these trades, as the stocks didn't retrace much from our entry point. So this helped prevent getting stopped out of our position and will increase the accuracy of your option trading. And the third rule when we're purchasing options is we use what we call the 1% rule to select the option strike price. If you use and select an option strike price that only requires the stock to increase in price 1% or less in order for the trade to break even and start profiting. So with the 1% rule, we like to limit the time value portion of the option to 1% of the stock price. And if we do that, the stock only has to go up 1% and we start profiting. So once you select an option trade, there's hundreds or even thousands of strike prices to choose from. So we use this 1% rule to help us select the strike price. So option premiums, of course, consist of time value and intrinsic value, and options lose all time value at expiration. So when you buy an option, you're buying a decaying asset. And due to these time decay characteristics, when you're buying an option, we want to minimize the time value because that's going to decay to zero, and we want to maximize the intrinsic value. So what we do is we simply limit the time value portion of the option to less than 1% of the stock price, and that will allow us to minimize the time value and maximize the intrinsic value. So as I mentioned, if you limit the time value portion to 1%, the stock only needs to go up 1%, and then you break even and start making money. So this will have a much higher probability of success than an at-the-money or out-of-the-money call that requires the stock to go up, let's say, 6 or 10% over a one-month period, which may not happen. And if it doesn't happen, then you lose 100% of your premium. So we like to use this 1% rule, and if we're wrong in an option trade, then we simply exit with about a 20% loss, and then that way we can move on to the next trade rather than incur a 100% loss and be wiped out of the game. So let's look at an actual example. This brokerage confirmation shows we bought the DVY, the dividend ETF, 70 strike call at 1170. And at the time, DVY was trading at 81.38. So if the stock was at 81.38 and we buy the 70 call, that's an in-the-money call. And if you subtract the strike price of 70 from the stock price, you come up with the intrinsic value. So we paid 1170 for the call, and the intrinsic value portion of that premium was 1138, and the time value was only 32 cents. So paid 1170 on the option premium, 1138 of intrinsic value. So in this trade, DVY only had to go up 32 cents, and we would break even on this trade and start making money. And this call option calculator shows the profit potential for this trade, assuming various price changes in DVY at option expiration. In this example, from a 30% increase in the DVY to a 5% decrease. And we can see that if the stock is flat, we'll 7% loss as opposed to 100% loss for an out-of-the-money option. And we still have a decent return potential if DVY is up 5% at option expiration. This option purchase will have a 32% return. If it's up 10%, we'll have a 66% return. So even though we're buying in the money and it costs more, we still get a good return if the stock goes up. So are our current call option purchases. I just took this yesterday, and this column right here, percent gain. So the first option is Applied Materials. We have a 38% return. Amazon, we have a 25% return. Quest Diagnostics, 1%. TV, 6% return. Small ETF IWM, we have a 247% return. NVIDIA, we have a 6.4% return. That turned into a loss today because NVIDIA was down, but spread trade on that, so that spread trade helped protect this profit in NVIDIA, and we'll look at that in a minute. In the QQQs, we have a 300% return, and in the real estate investment trust call purchase, we have a 24% return. So those are just our current so let's look at our next strategy, the option debit spread strategy. And call option trade, we use trade management rules, and we use one of those rules is to use options to protect our profits when we have a winning trade. So if we have a 30% or greater profit in a call option, then a call option with a higher strike price, which creates an option debit spread and helps protect our profit. So if we have a 30% profit in any call, then we'll create a spread by selling a higher strike price call option. So if you purchase an option and you have and then at a later date you sell an option to protect those profits, it of the existing option purchase, and then also provides downside protection if the stock starts to decrease in price. So when you have a bullish debit spread on the call option that you purchased, of course, profits if the price of the underlying stock increases, and the call option that you sold will profit as the price of the underlying stock decreases, and your risk is limited with debit spreads to the cost of the spread. So you can't lose more than the what you paid for the spread. So let's look at an actual example that we have on now, and our brokerage report shows that we bought the QQQ 105 strike call at 6:30. So bought the QQQ 105 call at 6:30. We have a profit in that trade, so at a later date, we sold to open the QQQ 122 strike call at 3:28. So again, bought the 105 call at 6:30. We had a 30% or higher. We sold the 122 strike call at 3:28. So once we sold that 122 strike call at 3:28, that created a debit spread, and that actually increased the profit potential for the 105 strike call purchase, and at the same time provided downside protection in the event the QQQ declines in price. So the optioneering team has designed a series of calculators to calculate the profit potential. We have these calculators for 6 different option strategies, including the option debit spread strategy. So the calculator calculates the profit potential for the option debit spread trade based on the price in the underlying stock at option expiration. So we'll look at this QQQ profit potential. Again, QQQ is trading at 130.22. We bought the 105 strike call at 6:30, sold the 122 strike call at 3:28. So let's look at the profit potential on this. This bottom row here displays the percent return potential, and the second from the bottom just displays the dollar profit. So let's say that at option expiration, QQQ is unchanged at 130.22. If that occurs, then we'll have a $1,398 profit and a 462% return. QQQ is up at all at option expiration will have the same profit, 462% return. So once we sold that 128, that reduced the cost of the 105 purchase from 630 to 302. So in other words, we paid 630 for the 105 and we sold the one call for 328. So the cost of the spread was $302. So if QQQ is flat, we'll have a $1,300 profit. If it goes down 5%, we'll still have a $1,300 profit. If it goes down 10%, we'll have a $918 profit. And if it goes down 15%, we'll have a $267 profit. So in this example, the QQQ could even go down 15% and we would still profit. Here's one more example. This is the IWM small cap ETF. We bought the 120 strike call at 564. We had a profit in the trade, so we sold the 135 strike call at 311. And trade, if IWM is flat at option expiration, we'll have $1,247 profit, 492% return. If it goes up at all, we'll have $7 profit. If it goes down 5%, we'll have a $1,066 profit and 421% return. So there's two examples of call option purchases we made. We had a profit in the option purchase, so we sold and increased the profit potential of the existing call purchase and also provide downside protection. So in the case of the QQQ, we purchased the 105 call at 630. So by selling the option, it reduced our total risk from $630 to $302. And as we saw, the spread can be profitable if the stock goes up or down. So there's a second type of spread strategy that we use in addition to the debit spreads. We also create market neutral spreads. And for our option portfolio, generally we do about, whenever we have a profit in a call, then half the time we'll do a debit spread and then half the time we'll do a market neutral spread. So let's look at the market neutral spread. The Prime Trade Select has produced a lot of winning call option trades. So whenever you call option trade, you have that winning trade dilemma, and you have to decide whether you're going to hold the trade for further upside potential or take profits in case the stock declines in price, with the possibility of your winning trade turning into a losing trade. So this is a good dilemma to have. So the question is, if you have a profit in your call option, do you want to hold that trade in case the stock continues to rally in price? But if you do that, then you have the risk that if the stock declines, then there's a possibility that winning option trade will turn into a loss. So we have that winning trade dilemma, and we solve that by our market neutral spread strategy. And when spread to hold the call option that you already own and continue to profit if the underlying stock increases in price, but at the same time you're protecting those profits if the underlying stock declines in price. And the way we create these market neutral spreads is if we have a winning call option trade, then at a later date we'll buy a put option to protect those profits. And I'll show you an example of that. Position, which is the call option, and a short position, which is the put option, we simply call this a market neutral spread. It's also known as a strangle spread. So 30% or greater profit in a call option purchase will purchase an at-the-money put option to protect those profits. And of course, the call option profits if the underlying price of the stock increases, and then the put option profits if the underlying profit of the underlying stock decreases. And your risk with market neutral spreads is limited to the cost of the spread, and there's no limit on the profit potential of the spread if the underlying stock continues to increase in price. So that's an important point here with these spreads. Your profit potential is not limited by buying that put option. And it's possible, and we'll show you some examples of this, it's possible to even guarantee a profit for your call option purchase regardless of the price movement of the underlying stock. And we'll show you an example of that, how we locked in a profit by buying the put option. So this is for DVY, the dividend ETF. It was on a prime trade select buy signal. So our brokerage report shows that we bought the 78 strike call for DVY at 460. So we used prime trade select in the Keltner Channels. We selected a low risk entry, and our call option was profitable. Again, purchased the 78 strike call at 460. So we had a profitable trade. And then what we did at a later date is we purchased the DVY 88 strike put option, and that's market neutral spread. So we legged into the spread by purchasing the 88 strike put. So you can see right here, our brokerage confirmation says we bought the 88 strike put at 120. We have a calculator for these market neutral trades, and again, that will calculate the profit potential assuming various price changes in DVY at option expiration. In this example, from a 30% increase in the price of DVY to a 100% decrease. Of course, we don't expect any type of decrease like this, but we're just putting it in there just to demonstrate the strategy. So again, we 8 strike call at 460, and then we had a profit in that trade. At a later date, we purchased the put at 120. So the calculator will calculate this profit potential, and we can see that if DVY is flat at option expiration, then we'll have a $778 profit and a 134% return. But if DVY increases in price, let's say we have a 10% increase in DVY, we'll have a $4 profit and a 292% return. And you can see that there's no limit on the profit potential. As the underlying stock continues to increase, then your profit potential also increases. And also importantly, if the underlying stock goes down, let's say it goes down 40%, which we would not expect, but if it did, you would still be profitable, and you'd have a $2,700 profit and a 469% return. So in this case, buying that 88 strike put option, in this case, guaranteed a profit, and our lowest return would be 134% return. And if the stock goes down, we'll have a higher return. So in this case, we locked in 134% return no matter what happens to DVY. So for Home Depot, and we 45 of the Home Depot 80 strike calls at 10.15 in this trade. So then we at a later date, we bought the Home Depot 110 strike put at 420. So bought the 80 strike call at 1015, and then bought the 110 strike put at 420. And let's look at the profit potential for that using the market neutral calculator. And for this trade, if Home Depot stock was flat at option expiration, we'd have a $2,082 profit on the spread and 145% return. And then our return goes up from there if Home Depot stock goes up in price. And also our return goes up if Home Depot stock goes down in price. So in this example, minimum return of 145% for this Home Depot spread. So once you buy that put option for protection, you can forget about your option trade. There's no need to bad earnings reports don't matter. A severe sell-off in the markets actually produces more profits with this strategy. So you can place the trade and forget about it until option expiration. So a sharp decline in the price of the underlying stock doesn't matter, and we don't have to worry about placing protective stops. And again, the risk in the market neutral trade cost of the spread. So as you can imagine, this is a great way to invest. And as veteran traders with a lot of experience, we've been burned many times by unexpected market declines. And if you own a call option portfolio that's heavily leveraged, you could wipe out the profits in that portfolio. So we're always looking, whenever we have a profit in an option, we're always looking to either create a debit spread or create a market neutral spread to protect those profits. And one of the worst feelings as a trader is you're sitting on a profitable portfolio of call options, only to see that portfolio turning into a losing portfolio. That's hard to get over as a trader. So you don't want to put yourself in that position. If you have a profit in a call option, you want to create a spread to protect those profits. And one last strategy I'd like to look at is the stock spread strategy. And this is kind of like the market neutral strategy for a call option purchase. And in this case, if we have a stock purchase, we also want to protect profits in a stock purchase. So trade select to select stock trades. That's done very well over the years. It's produced a lot of profitable stock trades. And you know, if you have a winning stock trade, again, you're facing that winning trade dilemma, and you got to decide whether you're going to hold that stock in case the stock keeps going up, or take profits in case the stock declines, with the possibility of your trade turning into a loss. So that's a good dilemma to have. So whenever you have a profit in a stock, and we'll normally initiate these stock spreads if we have a 10 to 15% profit, lock in that profit by buying a put option. So this is very similar to the market neutral strategy. And in this case, we own a stock and we have a profit in a stock. We want to protect that profit, so we simply buy a put option on our stock trade. So this is also known as a married put, and that, of course, solves that winning trade dilemma, because you're holding your stock, and if it continues to go up in price, then of course you're going to continue to profit. But at the same time, you buy a put option, and that protects the profits in the stock in case the stock declines in price. So what we do is, if we have a profitable stock trade, we always want to protect those profits by buying an at-the-money put option. And it's possible that you can, when you buy that put option, that you can even guarantee a profit for your stock trade. So, and when you buy that put, it doesn't limit the upside potential if the stock continues to increase in price. And another advantage of the married put strategy is any dividends that you receive on your stock, that can help pay for the cost of the put option. So that's also a very low risk strategy. You buy a dividend paying stock, the dividends help pay for the put option, and that really reduces your risk for trading stocks. So with a married put, you create it by purchasing 100 shares of stock and purchasing one put option, and the purchased simultaneously, or you can leg into the spread if you have an existing profit on your stock. We normally leg into these spreads when we have a profit in a stock to protect those profits. And I actually trade these in my retirement accounts. So the put option, when you buy that put option, of course, it limits your risk, and the put option acts as a floor for the value of the stock, and at the same time, your profit is not limited or capped. So let's look at an example. This is for the FAS, and I bought 200 shares of the FAS at 106.50. FAS then had a 3-for-1 stock split, so the split adjusted price for the 600 shares was $35.50. So bought 200 shares at 106.50, and then after the stock split, I had 600 shares at a cost of $35.50. So I had a profit in this FAS and bought to open the 70 strike put at $5.90. Now that created the married put spread, and by buying that put option, I locked in the profits for the trade. And at the same time, it didn't limit my upside potential if FAS continued to move up in price. So again, bought the, you can see here, bought 200 shares, FAS 106.50. They had the 3-for-1 stock split. I had a profit in the stock, so then I bought the strike put at $5.90. So we have a married put calculator, and that will put based on various price changes in the underlying stock, in this case from 150% increase to a 100% decrease in the stock price. And I didn't calculate in the entry date or exit date because it doesn't pay a quarterly dividend. So if you have a dividend paying stock, then you'd want to enter the entry date and exit date, and then it'll calculate the dividends you received over that period, and that it'll take that into account on the profit potential for the trade. So in this case, we didn't fill that in because the FAS wasn't paying a dividend. So again, we paid $35.50 for the stock. We bought the 70 strike put at $5.90. So let's look at the risk potential and profit potential on this trade. And we can see that if FAS is flat at $35.50 at option expiration, then we'll have a 72% return. So, and if FAS stock goes down, we wouldn't expect it to go down this much, but if it did go down, you still lock in a profit. So basically, by buying that put option, we locked in a 72% return for the FAS ETF. And if the stock continues to go up, there's no if the stock goes up. Here's one more example. This is for TNA, that's the small cap ETF. Bought 200 shares at $52.84, and it had a 2-for-1 split, so the adjusted price for 400 shares was $52.84. We wanted to lock in the profit, so we bought the 55 strike puts at $5.50, and that created a married put trade. And here's the profit loss potential for this trade. And again, we paid $26.42 split adjusted, bought the 55 strike put at 550. So if TNA is flat at option expiration, we have a 72% profit on the spread trade, and if it goes down, we locked in the profit at 72%. So this is a way to protect our profits. So whenever we have a profitable stock trade, we create a married put, or we sell a call option and create a covered call. So for our profitable stock trades, we either create a married put or a covered call, and for our profitable option trades, we either create a debit spread or a market neutral spread. So these strategies have all been working well in the current market environment, and we continue to trade those. So with the married puts strategy, once you buy the put option for protection, then you can forget about your stock trade until expiration. You don't have to worry about putting in a protective stop or severe market declines, because you're already protected with that put option protection. So bad earning reports don't matter. A severe sell-off doesn't matter. So you're protected. My presentation for today, and if you're interested in the strategies just presented, then you can log on to Chuck Hughes IC, or you can call Brad toll free at 866-661-5664, or 310-647-5664. So if you're interested in the strategies, just log on to the website or call Brad. So that
Chuck, why don't we leave that up for a minute, Chuck? Why don't we leave that up for a minute so people can write that down? We have a slew of questions, and what I'm going to do, Chuck, is the ones that we have a half a dozen of the same question, I'll try to word it the same way, so we can get through with this.
Okay.
You said that you use the Keltner Channels. Can you use the Keltner Channels with ETFs as well?
That's a good question. Yes, the Keltner Channels are available for ETFs as well, and of course the Keltner Channels just track the daily price movement over the last 20 days, and that's how the channel is created. So yes, you will get the Keltner Channels for ETFs.
Regarding your selection of picks, Chuck, where do you start looking for potential trades?
Okay, and at the new 52-week high list every day, and when we see a stock that starts showing up on that new 52-week high list, let's say Amazon or Google, if it makes a new 52-week high, then we put that on our list, and those are usually the best candidates for these bullish trades, whether it's a call option purchase or a call option spread trade. If we're looking, we look at the 52-week high, and during the bear markets, of course, we look at the new 52-week lows. So that's where we start our search. We look at that 52-week high list. We write down those stocks that are making the new 52-week high, and then we wait for a retracement with the Keltner channels to that middle or lower channel, and that's when we pull the trigger and enter a trade.
Asked, with the volatility that we're seeing in the markets, for whatever reason that may be, are you finding that a lot of the bid and the asks are becoming wider than usual? Have you noticed any type of trends there, Chuck?
That's a good question. We normally just trade the very liquid stocks and that have over 1 million shares traded every day. And when you do that, they have fairly tight bids, and usually it can be anywhere from 5 to 10 to 20, 30 30 spread, which brings up another good question. In order to mitigate, that bid-ask spread, we'll use limit orders when we enter an option trade, whether we're buying or selling an option. We will use a limit order, usually halfway between the bid and ask price, and we can normally get filled in that area. So if you're concerned about buying an option or selling an option in an illiquid stock or ETF, then you definitely want to use a limit order to mitigate the cost of the bid-ask spread.
Chuck, Wendy Elise is asking if you could utilize the delta neutral trade strategy for options on futures.
So that's the market neutral strategy I think she's talking about, and you could use that on futures, and I've used it before on the stock index futures options. In other words, like on the NASDAQ 100, there's options traded on the NASDAQ 100 futures contract as well as the S&P. So you could trade either debit spreads or market neutral spreads with those stock index futures options. And I've done that many times in the past. And again, when you're trading options, whether they're futures options or stock options, you want to use that limit order to mitigate the bid-ask spread cost.
Chuck, we have so many participants asking about that big free report you're going to hand out to all the attendees today. Can you comment on it real quickly?
Oh yeah. That I developed that over the years, and we go into detail on covered calls and option debit spreads and the income that you can create from either selling covered calls or selling debit spreads, and millions of dollars in premium income using those strategies. So I go into detail on that report showing you how to collect this income from covered calls or from option debit spreads.
Well, Chuck, thanks again for putting on an awesome webinar. I got to tell you, you're getting a lot of accolades from your attendees today, and I'm not going to go down the list. I'm sure you could read some of them as they're coming across the tape, but I'm hoping to have you out again soon, Chuck. You are, for those that don't know, Chuck is a great giver of his time. Chuck does not get paid to do these. He does not get endorsements to do these, promotions to do these. He does this because he literally believes he makes a difference when it comes to people trading. So that number on the screen, give it a call. Chuck's support staff is really, really good. They're very handy, and Chuck is very punctual in returning specifics regarding strategy. So, Chuck, I hope I can have you up and out again next quarter if possible.
Yes, absolutely, Tom. And thank you, Tom, for taking the time to set up this educational webinar. I enjoy doing them and look forward to the next one.
Thanks, Chuck. I appreciate it. Told the wife and kids we say hello here in Central United States, and we'll be in touch. Stay dry out there on the West Coast. And for everybody that is joining us, thank you very much for your patience. And by all means, we're going to get you out that free report, and we'll send you out some links for the recording here in the archive. Thanks for joining us, everybody. Chuck, we'll talk to you soon, my friend.
Okay, thanks, Tom.
Good night, everybody.
Have a good day, everybody.